For decades, Indian investors debated a single question. How much of my portfolio should India command? But the world has changed, as we've seen, with global markets more accessible than ever. The old answers may no longer hold true. And moderating this discussion, once again, is Kshitij Anand, editor, Markets ET Digital. By now, everyone's familiar with Kshitij. Yeah, popular guy around. And we have joining him Rahul Jain, President and Head, Nuvama Wealth. We've got Lakshmi Iyer, Group President, Investments and Chief Executive Officer, Bajaj Alternate Investment Management. Sid Swaminathan, Managing Director and Chief Executive Officer, Geo BlackRock Asset Management Company. And once again, Devina Mehra, Founder, Chairperson and Managing Director, First Global. Ladies and gentlemen, please welcome our panelists.
So much, everyone. I hope you had a good lunch, and now we are back for another interesting topic, global versus local, and this theme has actually picked up pace in the last 12 months, so has been there for quite some time now mind you, but definitely this theme has definitely picked up pace in the last few months or so, and definitely from our perspective we'll try and get the ideas as what should investors be doing at this point in time. Go global or remain local, or a combination of both to diversify the portfolio. So Rahul, let me start off with you. You closely track India's HNI or the wealthy investors, for say. Has the conversation shifted from how much India to how much outside India?
I would say that yes, the conversation, at least in our minds, has started moving, because when you look at Nifty returns versus a lot of other global indices,
sure,
there's a question which comes in your mind that is that the right strategy, or is some other allocation also required? But at least for us, I think the larger question still is not too much on global allocation, but on the asset allocation for Indians first. We meet so many clients that their portfolios are still very skewed either towards equity or debt. We believe that getting the asset allocation right is the first and foremost, because right now when you meet a lot of people, they say that it's best time to invest in equities. But if you're 100% already in equities, what else will you invest? But if you would have been debt, then some movement of debt to equity would have been a good idea right now. So asset allocation as a question is more pertinent. Below that, in the equity side, I think then looking at global allocation also becomes very relevant, because if you look at Korean markets, if you look at US markets, they have done far better than us in last 2 years. So I would say the pertinent question is that, is the asset allocation right for clients? And then the second question could be that, what should be the global allocation out of those? So I think that is how we look at.
So right conversations now are now happening. That's the positive part.
Yeah. It's started happening for sure.
Definitely. Lakshmi, let me come to you. Over the past few years, it's always been, I'm sure conversations were equity dominated, but now has alternatives also picked up in your conversation with clients?
Firstly, hi, good afternoon to everyone. The post-lunch session is the most difficult because the Madhya Pradesh is full, so Uttar Pradesh need not work, so the eyes are shut. But nevertheless, this is a topic which is...
this is an eye-opener topic for
it's
you.
Not an eye-opener topic, but I'd say this is a topic which is very tactically played,
Sure.
not just alternates or MFs or otherwise, but
Yeah.
the fact is, or equities, but the fact is, when... one asset class does well, everybody is chasing that asset class. When one country does good, everybody is chasing that country. And unfortunately today, the recency bias is so high that our home turf is obviously on a weaker inning. So I think from that perspective, this conversation becomes quite interesting. So I'd say, extending Rahul's conversation, I'd say that, investors crave variety.
Yeah.
Whether it's for their taste palette or whether it is for their portfolio palette. So that's point number one. When we talk about variety, they are talking about variety in asset classes, they are talking about variety in geographies, and that's how the true diversification happens. So is that conversation happening today? Yes. Was it happening yesterday? The answer is yes. Will it happen tomorrow? Again, the answer is yes. But the pace and the intensity keeps changing from time to time. So again, if you look at, and we are all big fans of data, if you look at data, the AIF industry is growing more than double the size of the mutual fund industry. Skeptics will say, "Ki base dekho kitna hai," and obviously for that extent. But the point is, next 5 years also we are projecting the industry to grow at this pace because it is giving you access to every asset class that you crave. So it's the one-stop shop for your solutions. Is it here to stay? The answer is yes. Are conversations getting deeper? Again, the answer is yes. For example, let's take real estate as an asset class.
Sure,
Indians love real estate. Globe loves real estate. So today, if you want to do real estate, what do? You can do real estate through equity. You can do real estate, obviously, through debt because there are assets available. And you have funds which cater to that requirement through sector funds and private credit funds. Through alternates, also, there is an opportunity to participate more meaningfully and in the size and structure that you want. So I think the good news is that if you want custom-made, bespoke, butler kind of solutions, that is also possible. If you want the typical commoditized stuff, that's also available. And so I think the conversations will only get further entrenched, and this is here to stay.
Absolutely. So alternates are here to stay. That's the key message. Devina, let me come to you. You've been the first, if I'm not wrong, 25 years back, you're the first global investor or global at that point in time. It was relevant back then. It is relevant now as well. How has the conversation shifted, or how has the conversation changed according to you?
Yeah, I mean, when I went global, that would be like in history books for a lot of people here. This was in the aftermath of what is now known as the Asian crisis, when the Asian tigers went through a crisis whereby between the currencies fell and the markets fell. So between the two, Taiwan was down 50%, Indonesia was down 90%, Thailand, South Korea, Philippines, between this 50 and 90 in just 1 year. And that was a wake-up call for me that this is the danger of putting all your eggs in one basket. And I had actually worked in Indonesia for a brief while to set up Citicorp security subsidiary. So it was like I could actually see it that, this is what can happen. And the other thing, of course, was I said, kab tak wahi Infosys, HDFC, Bajaj Auto, SBI karte rahenge. I want to look at more companies, more different markets. So in 1999, we were not just the first Indian, we were the first Asian members of the London Stock Exchange, other than the Japanese, and the next year of the US Broker Dealer Association. So I've been following global markets since 99, and not just US, Europe, even the bigger companies in China and Japan since then. And our research was covered by Forbes, Fortune, Business Week, all of that back then, Wall Street Journal. So, I mean, one was, of course, as I said, these were my motivations at that time, but the fact that you should not put all your eggs in one basket still holds. The other thing is that when I started my career, the dollar was 12 rupees. So if you're talking of long-term goals, saving for long-term goals which are 10, 20, 30 years hence, you cannot forget that the rupee depreciates. In the morning, I already gave you that statistic that India is only less than 3% of the world market cap. So there's no logical reason why 90 or 100% of your investment should be there. So those are the logical reasons. And if anything, now hard currency expenses have gone up, lot more of the children go abroad to study. People's children, settle abroad, and they say after retirement we'll spend 50% of the time there. So basically, hard currency expenses are going up, and this is not something I've started saying in the last 6 months or 1.5 years. This has been the theme of my song for very, very long. That you must have reasonable global investments, and not just in the US, because US and India are not the world. And so that you have to, really think very carefully about your long-term savings. Still, Indians, because many of us grew up at a time when you could not invest abroad, long after I started working, you could take out only $500 once in 3 years when going abroad. So, that mindset is still there. We do not look at it. Good 20 years, the liberalized remittance scheme has been there, which is actually a very generous scheme. You can send $250,000 per person per year. Family of 4 can send out $1 million a year, but we are still in that old mindset when gold used to be the only thing which gave you a hard currency hedge. I mean, our grandmothers were not wrong in buying gold, because at that time you could not buy any other foreign currency denominated asset, but now that is not the case. So you have to look at it, but don't look at it from a knee-jerk perspective that 1 year India has not done well, so therefore let me go and invest globally, and there's a good likelihood the next 1 year might well be much better for India. So it is not that, it has to be a well thought out asset allocation that you stick to. That is the way to look at it. And again, I'm repeating, US is not the world.
All right, so US is not the world. That's a message coming from Davina, very powerful one, in fact. Sid, let me come to you. You've seen how investing has evolved globally. What is the kind of environment that you're seeing right now here in India?
Yeah, I think it's super interesting, firstly, coming from the UK where I was before moving here a couple of years ago. What I'm seeing here is a combination of things, right? Firstly, the pace with which the investor behavior is changing feels a lot faster than it has happened elsewhere in the world, right? So when you think about the basic behaviors like moving from saving to investing, then thinking about asset allocation of active and passive, more nuanced exposures, like all of that is happening very quickly, right? And then you add another dimension where the whole kind of digital ecosystem is growing much, much, much faster than anywhere else in the world. So that is very unique for India, right? And then you have this, I would say, the third dimension where the categories of investors are very broad. So you have such a large group of people that are not even investing and starting to get into investments, right? And their needs and requirements are completely different to the other cohort who have, invested mostly in equities, done really well, and now they're looking for other things to do. They're saying, okay, how do I diversify? How do I get global? How do I get alternatives exposure? So I think what's really fascinating about India at this point in time is that all of this is happening at the same time, and there's not like one single solution. So we have to segment the offering. So education has to be very, very specific to the segment of the investors. And so that for people who are just coming on board, it's more about SIPs. It's more about just get access to a mutual fund. Just be regular and disciplined with your investing. That will be a game changer for you. Whereas those who have already invested 100% in equities, you say, actually, maybe you want to think about debt. Maybe you want to think about global allocations. Maybe you want to think about some alternatives. So it's so different, and that's what makes it very exciting for all of us.
Absolutely. Now, let me come to you. In a world where we are seeing a lot of geopolitical concern at this point in time, and I'm sure a lot of your investors would have come to you with a concern as to what we should be doing at this point in time. So how does this global diversification look for, especially for the HNI, ultra HNIs that you've been recommending?
I would say that again, coming from my previous point, that while geopolitical is becoming very uncertain, the uncertainty largely impacts equities, if you see. So if your portfolio is rightly balanced, then some part of uncertainty is getting taken care of. And that is where the core work will happen. If you want to put global allocation, you will do how much? Suppose hypothetically a client who holds a 10 crore portfolio, suppose he will put 50 or a crore, correct? And then if he does any outperformance on that, on hindsight, we say that US did very well or Korea did very well right now. But when you're putting, you just take a basic outperformance. On a 5% of portfolio or 10% of portfolio, because as an Indian, I'll be more comfortable investing in my segment, something which is in my comfort space. While Indian equity itself is complicated, global equity is more complex to finally navigate through those. So the real delta or alpha would be very difficult to ascertain, or bring out alpha also. So you can do for some experimentation, but the core comes back that if your asset allocation is right, going out through the uncertainties, volatilities, you can navigate it better. And again, like what Divina said, that don't invest globally because India has not done well for last 24 months. It will come back strongly. That is our belief. Also, do in staggered manners and don't do as a knee jerk. Because end of the day, right asset allocation and underlying asset allocation under equities, debt, do right allocation among private public markets, startup, global allocation, listed equity. I think that will make more sense.
Absolutely.
On the geopolitics, Kshitij, if you permit me, I mean, I have looked at 125 years of data from 1900 onwards on all the major geopolitical events. So this is the 2 world wars, the 2 Gulf wars, 9/11, US bombing Libya, Afghanistan, whatever. And the conclusion is very clear that do not react too much to geopolitics because it all evens out. And this is exercise that we first did when the Russia-Ukraine tension was building up in 2022. And on the day the war broke out, on the day I had made a video saying the markets will forget about it in 6 months. Because, this was not a statistical exercise. I didn't find an exception. Every single case, the markets forget about it unless the country is directly in the conflict and is defeated. So, if you were Germany or Japan in the Second World War, those are the only kind of exceptions. Otherwise, the usual crisis in financial markets happen for other reasons, not geopolitics. So other than direct impact on commodity prices and that impact on a company's earnings, you should not spend too much time on geopolitics.
Absolutely relevant point there, Devina. Thank you so much on that. But Lakshmi, let me come to you. I always remember whenever we used to have this conversation back then, you always give this anecdote from Bollywood. And why I'm saying that is the party of private credit has been happening globally. How relevant is it for India nowadays?
See, I'll tell you, private credit is a great vehicle in terms of channelizing credit to the real economy and diversifying sources of funding from the banking sector. So I think that is the preamble and the genesis that is here to stay. The issue comes is when there is free party going on and everybody worth his and her salt thinks that private credit is a medium for raising easy bucks as a manufacturer, and everybody wants to set up his or her shop and try to raise a couple of $1,000 and what happens is when there is it's a law of economics, right? When there is significant demand which is chasing too few credits, what happens is that you end up potentially mispricing a category or an asset class. So I think that's true for equities, that's true for startups, that's at different points in time. There was this massive rage just after COVID, early 2021 or just late 2021, that late stage growth funds were very popular. And why they were popular? Because it was completely a fad and a craze, and you had the FOMO wali feeling. So, if I miss out, I just miss out. So people saw Durandar out of stress, saying that, everybody is raving about it. It's such a big box office grosser. And even if the movie was great, but how many people have tolerance for a 4-hour movie? Attention span is receding. So I'm saying that if structured nicely and well, see, US is facing its own challenge. That problem is not there in India. So, we should not contaminate or we should not extrapolate that. So I think it's a great asset class. There is money to be made from every category, from every perspective. There are sectors which rightfully need money, and I think that need can be solved by private credit. I think as investors, we just need to be mindful of mispricing, and we are BARP, B-A-R-P, buy at a reasonable price. We are not BARP, buy at any price. Whether it's for equity or for credit, I think the same norm holds good.
Right, buy at any price is not something we are looking at. Nice anecdote there. Thank you so much on that. Devina, let me come to you. More than 2 decades now, what are the mistakes which one should avoid when they're doing global investing? One of the things which you already pointed out that avoid global geopolitical concerns, which anyways comes forth. So yeah, it happened, but don't react to it. Over to you on that.
Yes. So the other one, which I mentioned briefly in the first part, was that don't think that the US is the world, because the people think that all world stock markets always move in sync with US, with the US being the leader. But there have been long periods when the US underperformed. So as I said in the first panel, that one thing is certain about markets, that themes change, whether it is countries, asset classes, even investing styles. So US, for example, 2003 to 2000, about 7, 8, that was the period when US wasn't even coming off a high. It was already down after the tech crash. And still in those 4.5 years, it gave a return of only some 60-odd%. At a time when India went up 6 times, the emerging market index went up about 3.5, 4 times, Brazil went up 10 times. And see, in anything that happens in the market, the narratives follow. So at that time, it was though the US is over as a country. That is when BRICS acronym was coined, that now the world has moved on from the US and the leadership moves to the BRICS. Then when the US started outperforming again, those stories were forgotten. So, that is the whole point, that markets always change. Often, I mean, if you look at the global markets, the top 40, 45 markets, very often you will find that the bottom 5 markets, at least couple of them will be in the top 5 in the next year. Even countries with real problems like, in the recent 5-6 years, there have been Russia, Turkey, Sri Lanka, who went from the bottom to the top. And of course, 2022, and now everybody has forgotten that in 2021 was the last time we had a global fund boom in India, when a lot of NASDAQ ETFs and funds of funds were launched. And 2022, NASDAQ was almost the worst performing index in the world. It was 40 out of 42 countries. And people came to me and said, I'm down 40%, should I exit? I said, don't compound a bad buy with a bad sell. Because a major index down 40% is almost never a sell. A stock down 80% can also be a sell. That's the thing, that be in a truly globally diversified portfolio, which is of all countries, all asset classes. The other thing is choose your fund manager carefully, because unfortunately, and I wrote about it and people said you're going to get lynched by your community for this. Too much of the asset management industry is an asset gathering industry. They are not offering you a product because they think that's the theme that will do well. Too often they're offering you a product because they think this is when I can get money from investors on this theme. And this is what is happening with a lot of gift city product. Very unfortunate. I just collated the data, and most gift city products have done very, very badly for the last 6 months and 1 year. Nobody is even close to the benchmarks, because global investing is extremely complex. Global companies are complex, much more complex than India. The list itself changes. I mean, in the early 2000s, when I started doing the US market, tech majors meant companies like IBM, Dell. Cisco was once the most highest market cap company in the world. Now the whole list has changed. I mean, barring Microsoft, which was a major then and is a major now, the whole list has changed. I mean, not that those companies have gone out of business. So, I mean, to understand that, you can't do that with 2 analysts, and just because you can form a gift city product doesn't mean you know how to manage global money. So be very careful on who you go with that. So those would be my 2 things, that don't think US is the world, and be very careful on how you do the global investing.
Absolutely. Sid, let me move on to you. And, traditionally, India has been a very active management space. But do you think that passive investing is something which is at inflection point at this point in time?
Yes, very much so. And if we just look at some of the stats, right? So just in the last 10 years, passives as a function of the overall industry has gone from 1.5% to now 18%. Right? It's huge. So that's actually faster than the rate of growth that we saw in the US and UK. US, I think, went from 2 to now 50, but that took 3 decades to get there, right? And the UK went from about 6% to now it's about 25%, and even that took 15 to 20 years. So it's moving pretty quickly. And there's a few things that are, I think, fueling this as well. So one is the market maturity, right? Which is, as you get to a stage, and we're getting to that stage now where markets are getting more efficient, the equity returns are not always hyper-normal, right? So yeah, and you've now seen 18 months of flattish kind of returns. So then people start thinking about that in terms of, okay, what am I actually getting for the fees that I pay, right? Alpha becomes harder to generate as well, and we're seeing that with especially sectors like large cap, where almost over 70% of the funds aren't delivering the alpha. So when these kind of phenomena start becoming more, let's call it prevalent, investors start to clue on and then say, okay, I don't want to completely shy away from the markets, but is there a way for me to just get more efficient access to the beta? And that's when the passive funds, whether it's ETFs or mutual funds, come in. And that's the behavior that we're starting to see. And it's not about active or passive, right? Like even globally, active funds still exist, still doing well, right? And so it's about active and passive, choosing which segments of the market can you then get very efficient access to cheaply, and then you've got that covered, and then focus on the active funds to get areas where there's still alpha to be generated. So absolutely, yes, I think we're at an inflection point. There's still a long way to go. We're still only at 18%, and these other markets are like 50 and 30%, like I said. So long way to go still.
Absolutely.
I just want to add on this
Sure,
active versus passive. While your active versus passive is like mutual fund versus ETF, there's a large community who does direct stock investing. which is more hyperactive. We keep telling them to move into passive because making money yourself on stocks is a very complex. Fund managers struggling to beat benchmarks, you as an individual will be way more difficult, where it's a part-time job for you. So I think that's also a big thing which should happen in India in that sense, where direct stock investing on your own versus a mutual fund and then ETF.
Absolutely.
Okay, one framework I would just like to add on this active versus passive. I mean, most people think passive is lower risk. Actually, to my mind, the only real value an active fund manager adds, I mean, most of them, I would say only, but mostly, is risk management. That if the market falls 30%, do you fall 30% or less? Because in an index fund, you will fall 30%. Because in a runaway bull market, it is almost impossible to generate alpha by managing it actively when every riff-raff stock is going up. It is when the markets go down that really, and that's what actually the data also shows, that the best performing mutual funds are the ones that outperform during downturns. There was one fund, it was a ET Money story, I think, where where the best performing funds were, as I said, which outperformed during downturn. There was a fund which outperformed in 90% plus of the up moves, but was among the bottom 5 funds because it fell more when the markets fell. So
right. Lakshmi, let me come to you. So a lot of money is also pouring into India's real estate via the other channels. So can we say that Indian investors are ignoring the party at home?
Money is flowing to India's
Real estate.
See, I'll tell you, the two asset classes, apart from bank FDs, I must say, bank FDs
Sure.
are sold in the womb of the mother. So even before the child is born, he or she has a bank account. Aside of that, because obviously there is certainty of returns over there, aside of that, two asset classes which have magnetic pull. As far as the globe is concerned, I've just come back from the US and I'll share a couple of anecdotes on that as well.
Sure.
That Indians love gold, Indians love real estate. So does it really need to be sold? The answer is probably not. I was telling somebody jovially yesterday when this conversation happened on real estate that when I was getting married, my father asked my to-be husband and now my husband that, do you have a house? He said, yeah, it's on rent. He's saying, no, do you have your own house?
Okay.
You know, that thought process. And today when people ask that, and I was in the US, I
Sure.
met this very young girl. She was interning industrial internship after her work or something. She just got married and I asked her, where do you live? She said, I live Hudson Yard, which is Manhattan,
Okay.
very close to Manhattan. And then I said, oh wow, that's like a very fancy place. Do you earn that much? I mean, it was that kind of a conversation.
Right.
She said, no, because my work is so close by. I'm hardly like 15 minutes away by the subway. If I go to suburbs, it's obviously I save on rent, but timing it takes me an hour and 10 minutes. She said, I'm all of 26, just started my industrial training, and what I'm going to do is, and I'm married, and my husband is working, husband works with Meta. So what she said is that 3 years down the line, when we plan our family, we'll actually move into suburbs and we'll buy a house. So, you know, what my father told my husband now 25 years back, and what this 26-year-old girl is telling me is that ownership of real estate is age agnostic and
Is age
people
agnostic,
want to
yes.
own it. The ways of owning have become more democratized in India. For example, I tell people that if you are smart, you buy a house, one house. If you're rich, you have two. And what happens if you're a fool, then you have the third one. Is what I end up saying, because it's a physical asset.
Sure.
It's super illiquid. So REITs are the way of ownership. For example, it's allowing you to own a mall, a school, a residential, a commercial, you name it. It's allowing you, and there are so many listed REITs. We just saw one more recent REIT listing. So I think the ways of ownership have to get sharper and smarter, like the ways of ownership of gold has gotten smarter.
Right.
You know, NSE has launched a beautiful product. You have gold ETFs in the country. You had, once upon a time, sovereign gold bonds. So I'm saying the physical gold kind of found its way of these kind of ownership. So I think the ways of ownership are changing, but I think the fatal attraction is going to remain. So I don't think Indians are shunning real estate.
Right.
In fact, they are finding ways and means to own it outside the country also.
Absolutely.
So yeah, that's not going to change. So I think I won't call it a one-night stance. This is going to
Absolutely.
be like a permanent marriage. Yeah.
Perfect. Well, I think on that note, we have a few minutes left, and I think I'll open it for the audience in case Anyone has any question? Okay, good. We are seeing some few questions. Okay, back then, we have one gentleman back there.
So I'm Ayush Agarwal from Power Exchange India Limited. My question to the panel is, we are talking about global investing. I want to know what is the most efficient way of global investing. Because while I understand that the LRS limit is very generous, but there are a lot of bottlenecks, right? The $7 billion limit on fund houses was breached like 3 years ago. And like Devina mentioned, gift city funds are not doing too well. Now the third method which remains is to open a fund international broker account. So just two questions: what is the most efficient way? And second, with this rupee depreciating, do you see RBI shifting this $7 billion limit up because it has not happened for 3 years now?
Very difficult to say what RBI will do. But I mean, since this is a cause for me and has been for many years that Indians should invest more overseas, I've done what I can, which is that have a product which invests across all geographies and all assets and starts at $10,000, which used to be 7.5 lakh rupees not very long back. Now it is 9.5. Of course, there's a little more tax efficient product at a higher starting, but this is what we could do. And yeah, I mean, RBI changing that limit has not happened, and it's anybody's guess whether when that would happen. And given where we are on BOP and exchange rate, I doubt whether it's coming in a hurry.
Right.
I also want to add here that on the BSE platform now, you can invest in US ETFs. They're also launching a new platform equivalent to BSE Star MF, where you can do global bonds, ETFs, UCITS, again US stocks, and I think that'll be more convenient. Returns is secondary. I think that will depend on your research, etc. But convenience will come for sure through these platforms. Rather than opening a foreign brokerage might be complex because your custodian, where your shares will lie, there's an inheritance issue also if you invest in US stocks. So there are a lot of complication also. This might solve and make it convenient for you.
Thank you.
Right. Anyone else? So we have one gentleman here.
Hi, I'm Sandesh from ISI Global Market Intelligence. My question is, if you look at the local markets here, so there is a great support from the retail investors. So SIP worth 32,000 crore has been month over month been supported by retail investors. But if you look at the capital flows, there has been a great divergence, especially flows which used to come from GEM as well as few large foreign portfolio investors have been shrinking in last 18 to 20 months. The local fund managers are doing a great job with this kind of support from the retail investors. We're seeing sizable investments coming out of our own country, which is good because we believe in our very own India story. My question is, in order to attract capital flows once again, what is it that regulators can do? LTCG, we've been often hearing, is a deterrent, especially to FPIs, and most of the global markets do not have such frameworks to penalize foreign investors. Do we need to rethink, go back to the drawing board, take some reforms and measures which will eventually attract capital back into the country? So what could be those reforms?
Right, some 2-3 questions.
Can I just take
Sure.
that? I'll at least start with that. So first of all, see, in this framework, what we think is that when FIIs start buying, the market goes up. When FIIs start selling, the market goes down. But that's a leap of logic. Actual data doesn't support it. In the morning, we spoke about this period. Remember 1994 to 2003 when the market's net displacement was zero? 1994 is when the foreign portfolio investors started investing into India. I started the business because the market was open to foreign institutions. So I remember this whole story very well. So you would have thought this is a new slew of money that's going to come, and billions did come. There was no Indian mutual fund to speak of. And standing in 1993, you would have said this would take the market to new heights. And yet that was the only 9-year period in which the market gave zero returns. So, this is a myth. We might want to attract foreign portfolio investment from a balance of payment and exchange rate perspective, but it's a myth that they drive the market. They didn't drive it even when we didn't have these domestic flows. That's the whole point.
Just one point to add to your question is that, tax incentives or SOPs cannot be the only mechanism to attract foreign capital into any asset class. It's a great necessary condition. It need not be a sufficient condition. You have a gym in your house or next to your building or whatever. Doesn't mean that you go to work out every day. The answer is no. But it's a great motivator. Ultimately, the underlying asset class has to deliver returns. The country has to inspire confidence. Both of these cases for India is definitely an affirmative yes. And I always keep saying form is temporary, class is permanent. So I think we are in that wave where there is a turbulent phase. Anything that goes to act as a catalyst is more than welcome. But please understand, as Indians, a predominant portion of our portfolios, or most of our portfolios, are deployed in India, right? Yeah. But for a global asset allocator, he or she looks at it from a very different lens. And India, like US is a single country allocation. People bet huge monies there. China is still managed to get that status. India is yet to come to that radar. When you meet global asset allocators, they don't do single country allocation. India is a part of their allocation for sure. But we are getting to there. So I think all of these mechanisms I understand because of relative underperformance. Sure. It does happen. But I think we just need to keep faith. Yeah. First, keep faith. See, I am a big Bollywood fan, okay? But I do watch movies like Michael and Devil Wears Prada because that's Hollywood. And I also watch animes and Korean pop. But the fact of the matter is that the longevity still, and my heart still stays with Bollywood. So I think the larger good from an India perspective still stands. Okay. And I think the regulators will take, and I think the pink papers and blue papers are all full of that news, right? That we are going to see something sooner than later. Absolutely. So yeah, just keep fingers crossed and that hope continues.
No, it's all about we have to believe in the Dhurandhar that is inside of you, and that is inside India. Well, on that optimistic note, I think...
just 1 second. So I'm sorry, you've got a wonderful view and a wonderful audience, but we've also got one question from this corner of the room. Okay. If I can just have this gentleman, please.
Sure, absolutely.
All right. Hi, good afternoon, everybody. My name is Amit Sharma, and we run a powerhouse wealth management company based out of Mumbai. Sid, this question is specifically to you. You manage 1.3 trillion in the UK, correct? You had many advisors, wealth managers working for you. In India, there are direct funds, there are regular funds. When I work with an investor whom I'm managing 50 crores, 100 crores, what is one value addition that you would give to my company that takes me apart from the crowd? One value addition.
Yeah, I think the key value, like I said before, is this appreciation of the importance of asset allocation. So what does that mean? How do you personalize that to the end investor? Taking into account where they are in their life, what their near-term, long-term goals are, what is their risk appetite. If you're able to synthesize all of that, find the right building blocks. Now, depending on the investor, like I said before, it could just be very simple existing mutual funds, ETFs for, let's say, someone that's just getting started. Or if they're much more advanced in their life, it needs to be maybe more global allocations, alternatives, etc. If you're able to synthesize that need and deliver them the right asset allocation and the right advice, like that is going to be the biggest difference you're going to make to their wealth creation journey, right?
So you mean I can still be in tandem with the fintech companies also, like Nuama is sitting here, they are a fintech company. If we want to manage 20,000 crores in the next 5 years, then the alpha that he will generate, I'll generate will be almost the same. But what is the X value addition that we should be providing to them? Again, what you said, I'll implement that, but still.
But the final piece, right, which is you are closest to the client. Like that is the ultimate value addition, right? So a lot of the manufacturers like us, we are manufacturers, right? So it's less about the star PM, probably going to be more about the star advisor, because you're the one that ultimately understands the client, and that's the value add that you're going to provide using the right building blocks to deliver them the right portfolio.
So that's why regular percentage of mutual fund is more than direct, you mean? That's the reason why we are creating more percentage in the market today?
Exactly right.
Advisor based, so you always a manufacturer will need more advisors in the long run well.
That's right. So there is a value for advice, there is a value for access, and that's what the regular plans are doing.
All right, thanks.
All right. Right. On that note, I guess thank you so much for your time, ladies and gentlemen. And thank you, audience. You've been a fabulous audience with some smart picking of our panel here. So a big round of applause to everyone, guys. Thank you so much.